Good morning and welcome. I'm David Wessel, Director of the Hutchins Center on Fiscal and Monetary Policy here at Brookings, and I'm very pleased to be the host of the launch of this year's Geneva report. This is not an official copy; we just printed a few, but it's online at the both on our website. There's a link, and at the Geneva report CEPR website. As all of you know, we are in a period of great turmoil and change. I think people have been saying that from this podium for the last 75 years, but I think it's particularly true now. But much of the turmoil we can see pictures of Ukraine, Gaza, Sudan, the streets of our cities, whether it's National Guard or No Kings protesters. And other parts show up in the headlines almost every day. Tariffs, sanctions, and stuff like that. But I think that what's important about today's event is we're looking at something which is important, but almost invisible and intangible. It's about how geopolitics is leading to fragmentation of the international financial system, which for most people seems about as remote as Mars. But it actually has a great deal to say about the course of our economy and our financial system over the next several years. What will happen to the role of the dollar? What role will stablecoins and other digital currencies play? Will the global safety net function if the world is fragmented into different blocks? What will happen to currency swaps in an era where geopolitics has entered into the mainstream of central banking? How will we be able to finance the debts, the massive debts that not only our country but others have built over the last decade or so? So I think that the point of today's event is to focus on something which gets attention only from a small set of people. So the plan for today is there are 5 authors of the Geneva Report: Anusha Chari from the University of North Carolina, Nathan Converse from the Federal Reserve Board, Arnaud Mehl and Isabel Vansteenkiste from the European Central Bank, who will be participating virtually, and my colleague Gian Maria Milesi-Ferretti. In order to save time, I want to make a blanket disclosure. Nobody from the Fed or the ECB is speaking for anybody but themselves. Their views do not represent those of the governors of either central bank. Our plan today is Gian Maria will start, and then we'll have a presentation on each of the chapters. And then we're very fortunate to have a discussion from Maurice Obstfeld, distinguished international economist, former chief economist of the IMF, and many other things, which you can read about online. And then I'll join the authors on stage for a conversation, and we'll have time to take some questions. So with that, Gian Maria Milesi-Ferretti.
Good morning. So, as David said, when we started this report, the world looked different. This was about September of last year. We were really thinking, when we were thinking about geopolitical fragmentation and blocks, we were thinking about, if you want, a Western bloc, a China-Russia bloc, and a lot of non-aligned countries. We know the world looks very different now. And so an issue we faced was how we discuss a geopolitical structure that looks very uncertain at the moment. I hope that what we've done, what the evidence we have put together is useful to think through the implications of geopolitical fragmentation, even if we don't know exactly what shape blocks may take in the future. A brief roadmap. I will give you some sense of the weight of emerging and developing economies in global finance. I will talk about the US and its creditors. The US has not just a large public debt, but also a large debtor position vis-à-vis the rest of the world. And I will talk about China and the investment patterns of China, and then conclude by highlighting what the implications of these trends I will highlight could be for the global economy. So, first picture is a picture about shares of different country groups in global GDP, in the first line, and in various financial instruments that span cross-border financial holdings. The colors have the blue for a group of financial centers, which includes both traditional offshore centers, think Cayman Islands, British Virgin Islands, and economies like the UK, like Ireland, like Luxembourg, where most international financial transactions are really in an intermediary role. It's not on behalf of residents, but it is intermediating money that comes from elsewhere and ends up elsewhere. The yellow represents the advanced economies, excluding these financial centers, and the brown, emerging and developing economies. You see the weight of emerging and developing economies in global GDP. This is not a time series. It is just a snapshot of 1 year, but you see that the weight is pretty substantial. But the weight in other financial instruments is much more limited. And this contrasts not just with economic activity that you see on the first line, but contrasts with the evidence for global trade as well. Well, as we know, China is, a major player, and not just China, other emerging and developing economies as well. Let me switch to another chart that shows to you the balance sheet, external balance sheet of the United States from a bilateral perspective. So, who are the countries that are net creditors vis-a-vis the United States, countries or regions, and the colors that you see in the bars tell you about what financial instruments we are talking about. The most relevant one for the United States are bonds, what in jargon is called portfolio debt securities. That's what you see as the brown bar. Most net claims on the US are in the form of holdings of US bonds. The US bond market is a large fraction of the global bond market. The dollar is the main reserve currency. Central banks hold a lot of assets in US treasuries and other US bonds. But if you squint at the country groups at the bottom, I hope you can read those, but in case you can't, going from the left, you have the euro area, you have what we call Commonwealth countries, that basically Australia, Canada, UK, other advanced European countries, countries like Sweden, like Switzerland, like Norway, the Caribbean. Then you have advanced Asia, countries like Japan, Singapore, Korea, Taiwan. Greater China is China, Hong Kong, and Macau. And then you have Middle East, Latin America, emerging Asia. What you can see from that is that it is really advanced economies that are the largest creditors of the United States. There is a bit this idea that China is the largest US creditor. As you see in net terms from this picture, China is a relevant holder of US assets, but nowhere close to being the first if you take a broader perspective on regions. And as I show you in the next picture, this report is about fragmentation. We want to see not just what the positions are now, but the extent to which these positions have shifted since global geopolitical tensions have risen. We take arbitrarily the year 2017, which I think is actually a pretty accurate measure of when these issues really became more salient. And I am showing to you here how the creditor position vis-a-vis the United States of all these regions, in the same regions that you saw before, has changed during the past few years. And what the picture shows, the first, clarified blue bar is 2017, the orange bar is 2023, and the scale you see is billions of dollars, so range going to 3 trillion or so. You see that for China, the position is virtually unchanged since 2017, but you see a very large increase for the euro area, which is the second country there, second group of countries, and for advanced Asia, which you see, but also for other advanced Europe, so advanced economies more generally. So again, largest creditors, advanced economies, big shift during the past few years. Why? Well, one obvious way in which you accumulate claims is if you save more than you invest. And that is clearly one factor that has played a relevant role in explaining why certain countries have accumulated claims on the United States. But this is not all. A second factor that has been enormously important is what you were holding. Think of a portfolio of an investor. If you were holding bonds in 2017, you didn't do very well because interest rates have gone up and bond values, as a consequence of that, have declined. If you were holding the Magnificent Seven, you have made a ton of money. And it turns out that countries do not invest the same way. Most emerging economies, China included, have most of their holdings in bonds. It is central banks that hold claims on the US, not just in the case of China. In other countries, it's mostly the central bank. While many advanced economies, they hold portfolios of bonds and equities with a lot of equity, which has gone up in value a lot. And that is one reason for these shifts. There is a second aspect that is very important for China too, which is a conscious choice by the Chinese authorities to diversify their holdings of assets vis-a-vis the rest of the world, away from the United States and primarily towards other emerging and developing economies. Indeed, when we talk about China's creditor position, and you will see a bit more about it in the next slide, the largest share of assets come from foreign exchange reserves. But unlike in the cases of the United States and the euro area, which are the countries the other countries, areas for which we have a more in-depth analysis of the balance sheet, the data is really scarce. And what makes it very difficult to disentangle the extent of financial linkages between China and other economies is the fact that most Chinese investment overseas flows through financial centers. And hence, the immediate counterpart that any bilateral data identifies is typically vis-a-vis places like primarily Hong Kong, but also the Cayman Islands and the British Virgin Islands. I'm reproducing here the same chart you saw for the United States on the change in the creditor position. This time is a creditor position. China is a net creditor between 2017 and 2023 for China. And what you see if you start from the left is what you saw already for the US. The claims on the US have really not gone up very much. But you see that where a large increase in claims shows up is on the British Virgin Islands and the Cayman Islands, as well as unidentified claims. So it is just, bottom line, very hard to piece together a more complete set of data. But other ancillary evidence we discuss more in the report suggests, again, that claims vis-a-vis other emerging economies have gone up by much more than our penultimate bar there shows. I will close with 3 brief remarks on the global implications of what we have seen. The bottom line from the point of view of portfolio composition is really that it is very difficult for a bloc that does not include the West to disengage from advanced economies financial markets, because that is where the lion's share of financial market activity is. And hence, and conversely, that the loss of diversification for advanced economies in weakening their linkages vis-a-vis large emerging and developing economies, China, but we have a much more concrete case of Russia discussed also in the report. The consequences from a point of view of diversification are less severe. However, there are other aspects of financial integration where the consequences could be definitely more salient. And we see a lot of signs of fragmentation going on in foreign direct investment. That is much more closely tied to where global production takes place, and that could have more significant implications on efficiency, but also on things like controls of natural resources, technology transfers, spillovers. I am already in the red. I leave just this slide on until I go back to sit down. Thank you very much, and I leave it to the next speaker.
Thank you very much for having us, and to the organizers for giving the organizers of the Geneva report for giving us a chance to work on such an interesting project. You'll notice that Gian Maria talked about who was borrowing from whom, but not at all about what currency that borrowing was taking place in. And that's because Chapter 2 of the report really focuses on that, among other things, in looking at how the roles of different international currencies are changing or not over the last 2 decades or so. I will say again and emphasize that the views I'm about to present are my own and not those of anyone else at the Federal Reserve. A number of recent events have raised questions about how the role of different international currencies, the dollar, but others as well, might be changing. Things like central bank holdings of gold have been rising very notably at a time when the price of gold has been rising even more notably. Since early April, there's been a number of novel patterns in co-movement between the U.S. dollar exchange rate and a variety of financial assets that have raised questions about how the role of the dollar internationally might be changing. I won't go in depth into those here because the chapter contains 2 boxes on exactly those topics, which you should definitely read, and has, if I say so myself, a very nice treatment. But these are kind of motivations, and I think I hope that what the chapter does is give some broader context for looking at phenomena like that and giving the reader the tools to evaluate the significance of events like that. The chapter begins by giving some lessons from a novel but growing theoretical body of theoretical literature that uses, broadly speaking, the tools of international macroeconomics to analyze the role of international currencies. With those lessons in hand, I dive right into to the data and look at how the role of international currencies in official reserve accumulation, then looking at how the role of international currencies may or may not have changed in cross-border borrowing and lending, how international currencies are used in international trade and how that may have changed or not, and finally looking at foreign exchange markets and what currencies are playing leading roles and where we see changes. So I'll briefly highlight some takeaways from each of these areas today, but I, again, encourage you to take a look at the report because there's a lot there. To highlight kind of key takeaways right up front, without dispute, looking at across all 4 areas that I just mentioned, the dollar really does retain its preeminent role, equally in second place across pretty much all of those 4 areas. The euro is in second place and really has played a stable role over the last 15 years or so. We do see changes, which I'll talk about in a moment, but it's I think one of the big takeaways from the report that I'd like to emphasize is that many of those changes are in fact not driven by geopolitics, and if we are to effectively find where geopolitics is affecting international finance and in some cases perpetuating financial fragmentation, it's important to distinguish what's driven by geopolitics and what's driven by changes in the structure of the underlying global economy. And so a lot of the changes that I'll talk about today are driven by economic forces, but there are several instances where geopolitics is clearly playing a role, and kind of to foreshadow, that really is in a few specific cases of what's happening with official holdings of foreign exchange reserves, and also in some patterns of trade invoicing. So I mentioned there's this sort of small but growing theoretical literature that gives us some kind of like insights, ex ante insights before we get into the data on what we might think about the international role of currencies. And one very strong takeaway from that literature is there are strong inertial forces that make changes in the role of international currencies quite unusual, not impossible, but quite infrequent events. That and related to that is the fact that the role of currencies in one area, I gave you those 4 areas at the outset to kind of orient our thinking. The role of currencies in each of those areas is very interdependent on what's happening with currency use in the other areas. And this is something we can, in some senses, see in the data, but even more strongly take away from this theoretical literature, and important to bear in mind when you think about how things are changing or staying in the same, and the implications of any changes we might see. It's also important to note from this theoretical literature that there's a clear message that policy can play a role, that government policies can play a role, both in maintaining the role of a dominant currency like the dollar. Government policy matters, but also in terms of governments that would like their currency to play a larger international role. It is possible for things like encouraging the use of a currency in international trade to be effective and to give rise to a larger role for that currency. And then finally, this is something I'm not going to talk about in any any detail today, but this theoretical literature, importantly, I think, can give us some insights, can give insights into where we might be headed, what an alternative system might look like. And this is something that obviously we can't learn from the data because it's forward-looking. And this is, I encourage you to look at the chapter. I haven't kind of mentioned the references here today, since it's not a bibliography, but take a look at the chapter. I think personally, it's a nice summary, and also there's some great references there that you want to take a look at. Looking at so the first area that I said I was going to talk about, the role of international currency and foreign exchange reserves. So on the left panel, you see the share of the dollar and the euro in total world holdings of official foreign exchange reserves. You can see if the role of the dollar has come down a bit, but it's still very much the preeminent currency. The role of the euro holding stable. So this is kind of the one of the big messages, and you can see it here in this area as well. I would emphasize that what's been driving, or one of the messages of the chapters, what's been driving that kind of very gradual downward trend in the red line is a lot of it attributable to market forces. And here in the right panel, if we look at in the space of changes in the shares of reserves allocated to different world currencies. If you look at the bottom of the chart, what currencies have been being used more, it's kind of surprising in some sense. If you're thinking geopolitics might be a driver, you see increased share for the Australian dollar, the Canadian dollar, and that unallocated is a number of other currencies like Scandinavian currencies or the Korean won. These are these so-called non-traditional reserve currencies. There's kind of over the period we're looking at here, an increase in market depth and liquidity for those currencies. Reserve managers care about safety, but they also care about returns. Those currencies became more attractive. Reserve managers allocate more to those reserves. So the change that we're seeing here, in many ways, attributable to market forces changing structures of global financial development, not so much geopolitics. That said, if you look at the chapter, we do have a section that looks specifically at a couple instances where there have been geopolitically motivated reallocations of reserves, in particular away from the US dollar. Unsurprisingly, one of those is Russia. That took place in 2018 for a variety of reasons I won't go into here. You have to read the chapter. But also somewhat lesser known case of Turkey also did a major reallocation of its reserves away from the US dollar at a period, again, coincidentally in 2019 when there was discussion of sanctions on some Turkish officials. So a role for geopolitics there. Those two cases kind of highlight that it is logistically feasible for some countries to reallocate away from the US dollar in an important way. But those two cases remain kind of exceptions that prove the rule. Looking at the role of international currencies in cross-border borrowing and lending, again, so here on the left, I have the share of the currency in the total amount of bonds outstanding internationally, and then on the horizontal axis, the share of the issuing country in world GDP. So being higher on the graph means the role in cross-border borrowing and lending of that currency is bigger. And if the farther above the 45-degree line the point is, that means that the currency is playing an outsized role relative to the issuer's role in the global economy. The US dollar, the euro, still playing a very outsized role, partly due to, as I mentioned here, the US dollar, the existence of offshore dollar funding markets, a key piece of this outsized role for the dollar, which I talk about in some depth in the chapter. And then just to highlight the RMB is the Chinese renminbi, all the way down at the bottom of the graph, a small role in international borrowing and lending, and a role that's small relative to China's role in the world economy. And that's kind of like a translation of some of the trends that Gian Maria talked about a few moments ago. And then I'm short on time, but I'll highlight, I think, another example of changes, market-driven changes rather than geopolitically driven changes that are important to keep an eye on. The rise of emerging markets borrowing in their own currencies, an important development that's driven some changes in the space that I think it's important to appreciate. And I'll refer you to the chapter for more details on that. Moving on to world trade, again, a picture of stability. On top, we see the US dollar and the euro, the preeminent currencies used in invoicing of world trade. If you want more detail on this, I do have to emphasize that you should really take a look at the paper by my co-author in the report, Arnaud Mehl, and his co-authors, they have an updated, cutting-edge look at the role of different currencies in international trade. That's where much of the data in the chapter comes from. But at the bottom, going back to the chart, at the bottom of the picture, you see other currencies, slight uptick, some of which is the Chinese RMB. But again, you might think there's a role for geopolitics there, but a lot of it is simply that China is a large and has seen large increases in its role as a trading nation, and that's reflected in the fact that more countries in their trade with China are doing that trade invoiced in the Chinese currency. I go into more detail in the chapter, but there are important examples of geopolitics playing a role here. Here I show these are countries, essentially there's Russia and then countries that trade with Russia, and the share of their currency, their trade, that's invoiced in the dollar and the euro. And you see these large declines. And this is actually only through 2021, so not even taking into account changes since then. And this really shows that the role that this is an example where geopolitics has clearly played a role. This was clearly, in fact, some effective sanctions that were implemented after the 2014 invasion of Crimea, and also anticipation of further sanctions being implemented, and a real shift in the invoicing of trade with Russia and its trading partners in response to these geopolitical events. So this is one place where we can clearly see geopolitical footprints. And then finally, the chapter looks at which currencies are traded in international financial markets. Again, the dollar retaining its preeminent role by far. I will highlight on the right the changes. Not very exciting that the residual other categories at the top that has increased the most. In fact, ahead of the RMB, a lot of that is emerging market economies, currencies of emerging market economies, and that's a direct outcome of the fact, as I mentioned earlier, that emerging market economies are issuing more currencies issuing more debt in their own currencies, and foreign investors are buying that debt, and they want to be able to hedge those positions and also change to buy those assets, and that shows up in a larger role for emerging market currencies in international financial markets. So again, another example of a market-driven change in the international role of currencies. I am out of time, so I won't go through the conclusions in detail. I think I gave you a preview of what we find in the chapter, but a lot of evidence, I'll leave you with that. There's a lot of evidence of continuity in the role of international currencies, but important changes, many of which are driven by market forces rather than geopolitics, but also some places where we can clearly see the role of geopolitics in the role of international currencies and how that has changed. Thank you very much, and thank you again for having us.
I hope you can hear me in the room. Thank you very much for having me here today to present. I apologize that I cannot be in Washington with all of you here, but there were duties that called me back to Frankfurt. I'm presenting the third chapter of the report. It's worked together with Arnaud Mehl, who's here with me in Frankfurt today. And I'm basically taking off from where Nathan left it, where he's finding that he just presented is that in the international choice of currencies, economic factors have been much more important than geopolitical factors so far in driving those choices. But in particular, when you think, for instance, of reserve asset managers, you may think these are buy and hold investors, and they may be very slow moving in terms of their choice of currencies and if they make shifts. In this chapter, where we look at is in areas where we think maybe that could be the nucleus of change and where changes may occur quicker, because in the global payments, for instance, a payment relationship is a very short-term relationship, right? You buy and you move separate ways again. So do we see any signs of financial fragmentation there? Now, before going into the evidence that we collected for the chapter, I just want to spend 1 minute and 1 slide on explaining what we really mean when we're talking about global payments. So first, global payments, I'm thinking about cross-border payments. So you're making a payment from Europe to the US, maybe from South Africa to Thailand. And as a citizen, how you do that, maybe you go to your bank, or maybe you're using PayPal. And if you're very sophisticated these days, maybe you're already using a stablecoin. But this is really the tip of the iceberg in terms of how global payments work. And if you look below the water level, you see that it really consists of a large network of correspondent banks. but also of a set of institutions that take care of the settlement, clearing, messaging, and FX conversion. And you see them here listed on the slides. I refer you to the report if you want to know in detail what all these abbreviations and institutions stand for. But what I want to give you is two takeaways on them. First of all, these institutions are all Western-based. They're European or American. And second, for a long time, we didn't pay attention to them because they were geopolitically neutral. They served the world, and the system was efficient, it worked well, and it was safe. So basically, these Western-based infrastructures offered kind of a global public good. And as long as it functions from a international macro or finance perspective, we didn't necessarily need to worry about it. Now, this dimension changed around 2010 when the United States started to, and my slides switched too quickly here, impose sanctions on secondary sanctions on foreign financial institutions, which were basically not observant of US sanctions in the financial sphere. And for instance, BNP Paribas was one of the financial institutions that fell victim of that. And as a result of that, in particular, correspondent banks became much more wary and careful in how they were basically allowing cross-border payments to take place. So their compliance checks became much more stringent. And what we have seen is that, of course, for those correspondent banks, as costs increased, they retrenched to some extent from offering these services. And in some cases, actually, some corridors are no longer being served. And then surprisingly, may imagine that these corridors tend to be located in the global south. In addition, we have also seen that some institutions, in particular Iran, but more recently in Russia, after Russia's invasion in Ukraine, were fully cut off from the international payment systems. You may all have heard of swifting, de-swifting. So these institutions face such a de-swifting. And of course, all this put the attention in the emerging world on a vulnerability or a dependence that they had on these Western payment infrastructures. And of course, as a result of that, we've seen actually a flurry of announcements and to some extent also initiatives in the emerging market world to move to some extent away from this dependence on the Western infrastructures. One illustration that we have, and this is a chart from the report, is through a text-based analysis of communiques from both G7 and BRICS leaders. And we looked into the extent to which cross-border payment system initiatives were mentioned in these communiques. A 0 means there was no mention at all. A 10 would have meant that there were concrete actions announced. You can take two things from this chart. First of all, you see an increased interest, in particular BRICS leaders, G7 also stepping up. And second, so far, it's mainly initiatives announced, but not really concrete actions so far. In fact, if you look in the sphere of concrete actions, it's in particular the countries that were cut off from the system. So we're thinking about Russia, Iran, that have taken some concrete initiatives, but also China has actually taken an initiative and has set up a system for settlement, clearance, and messaging of interbank payments, basically. And this is called CIPS, so the cross-border interbank payment system. And you can see that there has been some take-up in this system, and you see this in the chart on this slide. So we're having no more or less transactions of a value of around $6 trillion on a quarterly basis, and around 2 million of messages basically per quarter. Just to put this, however, in perspective, if you look at SWIFT, the numbers are basically significantly higher. So the number of institutions connecting to SWIFT is around 10 times higher, more than 11,000. And in SWIFT, we're talking about 11.9 billion of messages a year, or around 47.6 million messages on average a day. So still much more significantly. Now you can ask if is it relevant, with which payment systems you deal with in terms of the macroeconomic or macro relevant factors. And of course, at least we have some initial evidence on that. And in particular, when we look at trade invoicing patterns, Nathan already talked about them. In this chapter, we look at them more from the angle of what happens if indeed you shift your payment system basis. And one, of course, that we can see is, for instance, the degree of which the RMB is used for settlement of China's external trade. And you see that has taken off notably. So it's around 40 to 45%, depending whether we look at goods or services. But of course, the starkest example is when we look at Russia's trade with China. And so before Russia's invasion of Ukraine, actually trade with China by Russia was mostly invoiced in G7 currencies. Whereas now between around 20 to 30% of it is invoiced in non-sanctioning currencies. So those currencies of countries that have not imposed sanctions basically on Russia. So a notable change. Now, the chapter also touches upon another factor that is relevant when we think about geopolitics, and that's technological change. And technological change is actually quite a bit changing the global payments landscape through new available technologies. And actually, these technologies, why are they relevant from a geopolitical perspective? Because this interplay between geopolitics and technology may mean that countries can actually shift quicker away from the Western-based infrastructures that we have for cross-border payments. And in the report, we present some work, and there's also a CPR working paper on this, which looks basically at whether there is actually a link there. So do countries that have adopted these new technologies, and in particular, we look here at fast payment systems, are they more likely to interlink with others that have adopted this new technology in case they're geopolitically closer? And just to note, fast payment systems is basically a new technology, not completely new, but it exists for the last 10, 15 years, more or less. And as particular emerging markets have adopted that domestically. And I think a good example of this, if you are interested in learning more about it, is the PIX system in Brazil that is actually very heavily used for domestic payments. And so many emerging markets have been looking also to link up with other jurisdictions to make also cross-border payments faster. And the results of this empirical study really show that there is a link. So those countries that are geopolitically closer are more likely to basically connect their fast payment system. So whereas geographical links are actually much less likely. And I'm going to spare you all the details on how we cleaned this up to make sure that we generally capture here geopolitics and are able to distinguish this from other factors. Another thing that is relevant to keep in mind here is that also technological interoperability is relevant. And I will come back to this in the last slides of the presentation. Now, a second technological factor that is shaping global payments, and for sure you've heard a lot about this because it's this attracted a lot of attention, at least last week in the annual meetings, it was a cross-current across meetings, are stable coins, right? And so the DLT technology also enables basically to have different ways of making cross-border payments that, for instance, do not necessarily need to rely on the cross-border correspondent banking network. Now, so far, we have seen a market capitalization of stablecoins steadily increasing. Compared to the global world of finance, it remains low. But what we do see is that it's already very much dollar dominated, and you see that on the chart of the left. Euro-pegged stablecoins are also showing there, but you just visually can't see them because it's such a small share of the market. Now, of course, what also attracted attention in terms of the discussion on stablecoins has been the push by the US administration to promote this use of dollar-denominated stablecoins globally. And of course, what in particular is seen as a reason is also that it would result in a higher holding by foreigners, basically, of US treasuries, because, of course, it's one of the reserves that can be held to back the stablecoins. Now, if you look at the chart on the right, what you can see it half full or half empty, the glass. Stablecoins are still a small player, basically, in these holdings of US denominated dollar securities. But of course, at the same time, if you compare it to some other jurisdictions like Mexico, Germany, South Korea, then stablecoins are already a larger player. And of course, the potential is there for a significant increase. Now, the reason why I'm mentioning this is that there are, of course, also some risks associated to holding these stablecoins, and in particular from a financial stability perspective. And we can very much look back at what we've seen in the late 19th century when, what we're calling now banknotes at the time were issued by bank. And stablecoins remind us a lot about what's happened in that episode. And so it is a factor to keep an eye on. And I really refer you to the report if you want to read more up on this and learn more about this. Now, I've mentioned basically that, so far fragmentation in global payments, there are initiatives taking place. They are not path-breaking yet, but there's, of course, a potential, and a particular technology could accelerate this. Now, we can ask ourselves the question, what does it mean if you would effectively see an increased fragmentation in global payments? And it's basically the counterpart to what I said in the beginning when I talked about all the advantages of having a global integrated system. And so if you have a more fragmented system, the first thing you're going to have is, of course, a more complex system, right? Because you're going to have different payment systems. And so making payments across those systems may become difficult, which can cause delays. So payments may occur slower. In case money needs to move around quickly, for instance, during stress period, liquidity could be disrupted. And it could also undo all the good work, let's say, that we have done in terms of facilitating anti-money laundering and terrorism financing checks. A second one is that these new systems may be having less or higher standards on cyber risks and on technicalities. So you could have actually a higher risk of disruption in the system, something that we basically hardly ever see or at all. And of course, that could have severe financial stability implications. It's really a 0-1 effect. A third one, of course, is that it could result in the loss of effectiveness of sanctions as a deterrent, in particular for situations of geopolitical instability. And a final factor that's relevant is normally when we talk about the international monetary system and we talk about currency choice, we think changes could be either triggered by changes on the trade side or the finance side. And there's a long debate whether trade or finance precedes the changes in international currency choices. Now we could think of global payments basically as a step 0. So choice between currency may be, first of all, already determined by the global payment system. So could this be a starting point for changes in trade, invoicing, or in the use of currencies for international finance? Now, I'm aware I'm running out of time, so I'm also at my last slide. One question is also, what is the way forward to ensure that basically we remain globally integrated? I mean, and I'm going to say very quickly here 4 points. One is we need to make sure that our systems remain up to date so that when we're offering global systems, that they are the state of the art. And there's the work in the G20 roadmap to make that sure and make sure that every country has good access to them. We just need to implement the G20 roadmap. A second one is that central banks need to make sure that when private sector solutions move to a more modern age, let's say DLT-based, central banks keep up pace. A third one is making sure that systems are able to talk to each other. And so this is about interoperability. And people all know the ISO 20022 messaging standard, which still needs to be much more widely adopted. And finally, of course, in particular, when we think of crypto assets, it's important to sustain global cooperation and, for instance, adopt also the recommendations from the FSB to ensure that the system remains stable and safe. Thanks.
Present the 4th chapter of the report, which is on the future of the international financial architecture. So what is the international financial architecture? This was a term that was coined at a G7 summit in Halifax in 1994. And so the pillars are essentially, it refers to the underlying institutions, mechanisms, and regulations that underpin the international monetary system. So the report really focuses on 3 out of the 4 pillars of the international financial architecture. Of course, the most important one is the role of multilateral financial institutions. The second is the global financial safety net. The third is mechanisms that govern sovereign borrowing, debt restructuring, etc. And the final one is the international financial system of rules and regulations. So we touch on the first 3, which is the global financial safety net, the multilateral financial institutions, and mechanisms for governing sovereign debt restructuring. We believe that the 4th pillar deserves a report of its own. So let me start with the global financial safety net. First of all, what is the global financial safety net? It is a set of mechanisms that are aimed at mitigating financial stability risks in an, as we know, a very interconnected financial system. So it's important to think about what I'm talking about today in the context of the fact that we are entering this period of geopolitical fragmentation at a time of immense international financial integration and also very high global debt levels. So here, when we think about the global financial safety net, it is a multi-layered system designed to prevent and respond to financial crises. All right, so we can think about this as emergency liquidity provision during crises of various sorts, such as balance of payments issues, currency crises, or systemic shocks like the COVID-19 pandemic. There are 4 components to the GFSN. The first is a country-specific first line of defense, which is foreign exchange reserves. The second is the bilateral central bank swap lines, which can be temporary or standing facilities. The increasing importance of regional financing agreements, which are basically, center around regional groupings or geographical areas. And finally, of course, the International Monetary Fund, which provides financial assistance on a global scale. It's worth mentioning that out of these four components of the GFSN, the IMF is the only one that is truly global and spans the world. So this is a picture of the global the bilateral swap lines as of 2022. I apologize that once the report was submitted, we then saw swap lines be extended to a systemically important ally, namely Argentina, but that's not here. So let's sort of continue and talk about both the benefits and the limitations of central bank swap lines and repo facilities. So the benefits, obviously, of these swap lines are they provide emergency liquidity support during periods of market stress, where there might be dollar funding liquidity might seize up. As I mentioned earlier, the Fed swap lines there are some countries that have standing facilities, others have temporary facilities. During the COVID-19 pandemic, the Fed also introduced the FEMA repo facility, which allowed countries which have treasury holdings to liquefy, not liquidate, those treasury holdings in order to get access to dollar funding during a period of market stress. And on the European side, we have the Europe facility, which extends to a number of countries. The limitations, and think about this in the context of geopolitical fragmentation, is that because these swap lines are not universal, they are inherently hierarchical and provide uneven access to liquidity support. In the past, it's been mostly major developed economies, and it excludes many emerging and developing economies from access to dollar or euro liquidity. The FEMA repo is really an exception to this rule because anyone who holds treasuries can avail of it. And in general, we've thought about these swap lines as having been governed by the closeness of the economic and financial ties. If I go back to this, if you really see the four nodes, it's the United States, Europe, China, and Japan. A new dynamic when it comes to swap lines is the emergence of the Chinese swap lines, which are designed to facilitate economic and international financial ties, but also promote the internationalization of the renminbi, and we can think about this as strengthening economic ties and possibly increasing geopolitical leverage. When we come to the other components of the GFSN, we have the IMF, which is an indispensable component of the GFSN, providing emergency financial assistance, as we know, through a variety of instruments during crises and also longer programs. The challenges are, of course, the stigma of approaching the IMF for assistance, the policy conditionality, and I'll get into this in a minute, the governance and the very important governance and representational issues that the fund faces. Reserves offer an immediate first line of defense. They're essentially self-insured support. So this is not risk sharing or supranational support. It's self-insured support and a domestic line of defense against liquidity shortages and speculative attacks. The costs are, of course, that you have to hold these assets in low-yielding assets. There are sterilization costs, and if these reserves are inadequately sterilized, it can lead to inflationary pressures. So Maurice has talked about this in his work. And finally, could regional financing agreements gain traction? These are still in the nascent phases, and we're in uncharted territory. And it's worth noting that several of these arrangements currently use the US dollar as their currency of choice. So going back to what has been spoken about in chapters 2 and 3 about the international role of currencies and the payment systems. So the way forward in the geopolitically fragmented world for the global financial safety net is these key mechanisms, which are the swap lines and IMF lending, require international cooperation. And this is really going to be necessary if we want to try and mitigate future financial shocks and ensure that the resiliency of the global financial system. With geopolitical fragmentation, they could be used as tools of financial statecraft, right? So you have this role of global financial stability, but they could also become instruments of geopolitical strategy. And as I mentioned earlier, this is a question that has come up with the network of Chinese swap lines, whether they could also be a mechanism to enhance geopolitical leverage. So what does the future hold? If we have further fragmentation, will countries rely more on self-insurance? We know that this is unlikely to be a global optimum because it does not comprise any sort of cooperation or risk sharing across countries. So, will other players, e.g. China, step in to fill the void if the US is no longer the center of the international monetary system? And furthermore, an important question for us to consider is that would continued policy uncertainty in the United States create space for other currencies, namely the euro, the Swiss franc, etc., to increase their market share of reserve assets? Let me come to the second pillar, which is the multilateral financial institutions and international forums. The geoeconomic tensions come at a time when the IMF lending capacity has been under strain, and this is a key moment for the IMF. This is a striking statistics that IMF resources currently stand at 0.61% of world GDP if we exclude the temporary lending instruments and facilities. The 16th quota reform is expected to increase quotas by 50%, but this has been agreed upon but not implemented. And these new facilities like the NAB and the BBA are set to expire over the next 2 years. I think a key challenge that the IMF faces and is also likely to be exacerbated by geoeconomic fragmentation, which will further complicate the geoeconomic realities, is that of the governance landscape. It is striking to note that there is a big deviation in the actual quotas that countries receive versus what the IMF quota formula would imply. And then we see that the developed countries, which the G7 now accounts for about 29% of world GDP on a PPP adjusted basis, is overrepresented by almost 9%. The BRICS, on the other hand, and the BRICS Plus, which now account for almost 35% of world GDP in PPP adjusted terms, they are underrepresented by almost a mirror amount. And so these governance issues are likely to continue to plague the IMF and lead to complications. I don't have that much time left, but I just want to say that we also focus on the third pillar, which is sovereign debt restructurings and the impact of geoeconomic fragmentation on that. We know that sovereign debt restructurings are notoriously complex, and primarily because there is an absence of an international bankruptcy framework. But the Paris Club, since the 1990s, is a blueprint that has worked well for many years. The system has also remained fit for purpose by including collective action clause, etc. Geopolitical fragmentation makes coordination, unsurprisingly, much more complicated and challenging for the creditor nations. This could delay restructurings, constrain lending capacity, and increase the pressure on multilateral institutions to participate in these debt restructurings. So let me conclude by talking about the heightened pressure in a fragmented world. The international financial architecture was already facing growing challenges, and the COVID-19 shock really, a systemic shock like that, really exposed the need for cross-border coordination and bigger lending capacity. The traditional multilateral bodies are under strain, and the traditional approach to debt restructuring has become increasingly inadequate, especially with the emergence of new lenders such as China, and a lack of transparency is also something that adversely impacts sovereign debt restructuring. So what does fragmentation do? It places heightened pressure on the international financial architecture. It might become more difficult to achieve global agreements, especially if there's an erosion of these international financial institutions and forums like the G20 for economic decision making. Importantly, this could lead to a rollback of surveillance and coordinated financial sector policies, which in turn could weaken the GFSN's credibility and may lead to the GFSN itself being inadequately resourced and slow to deploy. And let me end by saying a fragmented world order threatens the GFSN's ability to act as a global crisis backstop. Thank you.
Okay, thank you. Good morning. It's a real pleasure to be here to discuss this report, which is, it's really a fantastic report, and I have very, very little critical to say about it at all. One of the reasons it's so important is that, in the current debate, we're focusing very heavily on trade and trade fragmentation, and I don't think we are taking into account the implications for financial markets of what we're seeing. And these come in two ways. First of all of the factors that are leading to fragmentation in trade are also, to some degree, going to affect finance. And trade policy itself, as I'll discuss, is going to have a direct effect on the integration of financial markets. So it's clear that the globalized trading system that flourished, particularly since the end of the Cold War, is fracturing. And there are geopolitical forces that are very evident, but there are also domestic forces which are pushing in the same direction, and which to some extent help drive the geopolitical forces. International finance has shown a kind of Teflon-like resilience to all this, at least on the surface. And it has expanded since the global financial crisis, while trade has been much more stagnant. But the public backlash against trade that we've seen, and that is embodied in the policies of the Trump administration, contrasts very much with what we've seen in the financial sphere. As I said, financial fragmentation is coming, and it will grow, and it will be costly. The authors have run through these chapters. There's not that much to say about it. I don't need to repeat what they've said. But in the current environment, I would say that countries are facing much starker trade-offs between sovereignty and economic and financial integration. And the last time these really came to the fore in a way that was extremely disruptive for the international system, I would argue, is when the Bretton Woods system collapsed in the period from 71 to 73, roughly. But structural transformations, particularly since the end of the Cold War, may rival those that occurred then. Unfortunately, now the effects are likely to reverse globalization and not promote it, which I think was the net effect of what we saw in the early 1970s. There are a number of factors at work, but I think the geopolitical strains make it very obvious how international investment and international financial markets can be fragmented. one very basic insight that I think we should keep track of, and it's a very old insight, is that when countries face the risk of seizure of their assets abroad, the social return to investment falls short of the private return. It very likely falls short. And this is something that I think is going to increasingly inform national policies. The first clear statement of this, as with many things in economics, comes from Keynes. He wrote a paper called Foreign Investment and National Advantage in 1924. And later on, almost 4 decades later, the Australian economist Murray Kemp, modeled this formally and confirmed Keynes's ideas. And Keynes starts out by discussing what he calls the old-fashioned view from the pre-World War I period, the days of the gold standard, that, quote, the investor is capable of looking after himself, and allowing him to do so ensures, quote, national income will become greatest. Of course, in that period, we saw at the time unprecedented global integration and trade and very significant foreign investment flows between countries, supported by empire in many cases, and supported by military force in some cases. And by 1924, we were in a very different, much more turbulent world. And Keynes gives this example. Consider two investments, the one at home and the other abroad, with equal risks of repudiation or confiscation or legislation restricting profit. It is a matter of indifference to the individual investor, which he selects, but if the nation as a whole retains in the one case the object of the investment and the fruits of it, whilst in the other case both are lost. With home investment, even if it be ill-advised or extravagantly carried out, at least the country has the improvement for what it is worth. So this is his basic argument, difference between social cost and private cost, or private return and social return. So this leads me to believe that we're going to see more restrictions, certainly on outflows in a geopolitically turbulent world. I mean, we see this with the arguments for reshoring trade and restricting investments on national security grounds. And it's important to realize that if we see more outflow restrictions, these will more or less automatically restrict inflows. So we should expect the network of financial intermediation, the gross flows, to collapse in this sort of environment. There may be more pursuit of macroeconomic rationales for inflow controls or taxes, or measures to coerce other countries, what Anusha euphemistically called statecraft in her presentation. FDI flows show the clearest evidence of geopolitical stress. There's been good work at the fund by IR et al. And others showing the effects of geopolitics. There are also effects on trade that have been documented. And, more generally, we have to recognize that while we have seen a more nationalistic government come to power in the U.S., the political landscape in Europe, for example, is also very favorable to nationalism going forward. The financial sector historically has been a right target for populists of right and left alike. Let me come back to a point I alluded to earlier, which is that aside from policies explicitly aimed at restricting international flows, trade costs will themselves restrict international finance when they are heightened. Ken Rogoff and I wrote a paper now a quarter century ago, I'm sorry to say, on the role of trade costs in certain financial puzzles. And just to put it in simple terms, if there are higher trade costs, then real interest rates have more scope to differ between countries. So instead of seeing this big flow of capital between countries in response to small real interest differentials, you have a much more frictional system, and these flows are constricted. The same applies also to international risk sharing. If it's more costly for countries to share risks by transferring goods in times of stress, then international risk sharing contracts become compromised. Now, since we wrote that, there's actually been a fair amount of work in the last decade on this stuff. So I'll just run through some references. Ricardo Reyes-Heroles at the Fed has a terrific job market paper, which I hope gets published. It's a decade old on this. Eaton, Corton, and Neiman wrote a nice piece a year later. There's a very recent piece by Benny Kleinman and a group of co-authors, which is a general equilibrium model of world trade with financial and trade frictions. Arnaud Costino and Ivan Verning have a relevant paper on tariffs and the current account. And a very recent paper by Tarek Hassan and co-authors, which was at the BPIA conference a short time ago, shows how a sufficiently severe trade war can induce countries to switch their anchors from the dollar to the euro. Basically, if it becomes more difficult to access the U.S. market, the risk mitigation properties of a euro anchor become superior for some countries. Let me talk about the chapters and some of the key insights that I saw. Now, again, this is an incredibly rich report. There's so much here. It would be impossible to go through everything, and it was obviously impossible for the authors to go through everything. So I really urge you to put aside some time to study this. The chapter on stocks and flows, a lot of the research that I've cited and others cite focuses on FDI flows in the financial sphere. This chapter focuses on stocks. And the reason that's so important and so warranted is that if you think about how shocks affect desired positions, much of it comes through price adjustment. So if everyone in the world decides that they want to back off from the Treasury bill, for example, one effect is going to be a depreciation of the dollar, and that will reduce the share of treasuries in the global portfolio outside of the U.S. So if you just concentrate on flows, you may miss this. But in the short run, you're going to see bigger stock changes. So it's very important to take this perspective. Another point that Nathan mentioned is that many changes are not due to geopolitics at all, but just are reflecting improvements, in fact, in financial markets. So if you think about original sin, the problem of many emerging markets which denominated government debts in dollars and how that was destabilizing, we've moved considerably away from that in many countries, and this is generally viewed as a source of greater stability. It's not really about the dollar's dominance. Now, again, in assessing the dollar's dominance, it is still early days, and this report was started many months ago, and we've seen many developments since then. The dollar's vehicle role, another point I took away from this, is actually critical in trade, not just financial markets. So not only do financial counterparties, neither of whom is in a dollar domicile, denominate trade in dollars, but so do trade counterparties. Very interesting fact that is documented here. Trade invoicing may be the most fundamental of dollar functions. This is something suggested in Isabel's presentation. And here, this suggests that we really want to look very carefully at this. Now, we've seen some movement away from the dollar in commodity invoicing, not more generally in trade, except that there's been an uptick in euro trade invoicing, which the report documents. This is actually something we saw before, right after the euro was introduced, but that invoicing surge collapsed in the global financial crisis. RMB invoicing has risen. It remains low. And interestingly, more foreign exchange transactions are in EM currencies, not just the RMB. Global fast payment systems are very fragmented already, and this might tell us something about the future of stablecoins. The GFSN, I want to focus on a little bit in my last 90 seconds. It's already a patchwork in some respects, but there are unifying institutions and structures, one of which is the centrality of the US dollar. And again, this is something that seems firm for now, but as Nathan indicated, it might take a big shock to dislodge it. We're seeing very big shocks that are unprecedented in the post-war period. Pursuing bilateralism rather than multilateralism can raise coordination problems. And here I think the chapter Anusha reviewed is really spot on in focusing on the debt resolution framework as a key element in international risk sharing. You know, my one criticism of the paper is that there's not enough discussion on the international financial regulatory coordination framework centered on Basel, the FSB, the sort of soft law framework, which has evolved pretty organically through the actions of central bankers and securities regulators. It's mentioned at the end, but I think it is very important. Okay, so international financial markets have become increasingly broad, deep, and complex since the Cold War ended. They're dynamic, underlying technologies are changing, and the role of third countries is rising. At the same time, the U.S. has now become quite revisionist. It's a revisionist power. And the ambitions of the key trade power, China, are pursued as it speaks the language of multilateralism. Is it really sincere? We'll see. Great report, wide-ranging. It's indispensable in a time of turmoil.
So Gian Maria, Anusha, and Nathan. I want to thank the authors and particularly Maury for that very thoughtful discussion of the report. And I would be remiss not calling out our colleagues at CEPR, the Center on Economic and Policy Research, for sponsoring this report. We don't have copies for everybody, but as you leave, we have a postcard that has a QR code on it. So I recommend you take it, because it took a lot of work to get these produced here. They weren't, unfortunately, not here when you came in. And I also want to mention that on the Brookings website, all the slides that you saw will be, if they're not up there already, they will be there soon, because I know that's often helpful. So I only have a few minutes, and then I want to give the audience a chance to ask some questions. But Anusha, I wonder if I could start with you just for a big picture question. And I should say I want to welcome Arnaud to the conversation in Frankfurt. Anusha, so can you just put this in the big picture? Why should a country, its citizens, worry about continuing the integration of financial systems? What is its importance to productivity growth, to financial stability, to living standards in general?
Thanks, David. Great question. I've spent, a large part of my career working on the benefits and costs of international financial integration. And let me just take you back to the Washington Consensus, which really promoted trade and financial integration. And we can see that the evidence strongly shows that when capital scarce countries in the emerging and developing world, when they were in financial autarky and then they moved to becoming more financially integrated with the rest of the world, we saw capital flow from countries that are capital abundant, where rates of return are low, to countries that are capital scarce, where rates of return are high. The evidence suggests that led to a fall in the cost of capital, increasing real investment, and promoting growth, right? So that's the benefit side of the picture. And we can really think about this financial and trade integration, both of having raised standards of living around the world. On the developed country side, it provides opportunities for these higher returns and risk sharing, increasing the portfolio of assets that are available for investment. Emerging market equity and debt were not even an asset class in the late 80s and have gradually emerged to be very important asset classes. So those are the benefits. Of course, we've talked a great deal in the context of crises about how the spillover, the contagion effects across borders. If you're more open, you're also more susceptible to contagion. And also there's a lot of debate about, say, U.S. monetary policy and the spillover. So, there's a very nice from ECB authors, a paper that was published in the JIE, which talked about when the Fed sneezes, who catches a cold. Thanks. So let me stop there.
Arnaud, one of the points that the book makes that we didn't get a chance to talk about is why emerging markets and developing economies are so vulnerable if we end up with disintegration or fragmentation of the global financial system. Perhaps you could explain why that is.
The reason is that they are more reliant on external funding than other economies. So that if you have a dry up in capital flows coming from external sources, these are the ones that would be the most exposed. Obviously, you have heterogeneity across emerging markets. Some have stronger fundamentals than others. Some have stronger institutional frameworks than others. And as a result of that, they may be less vulnerable to a uniform dry up. So there could be heterogeneity as well. But that's not why we are there. That's more a hypothetical scenario for the future if things don't go in the right direction. And there are ways to avoid things going in the wrong direction.
I see. And Isabel, you spoke very briefly about the policy recommendations in the report. I wonder if you could elaborate a little bit on this. If we, and I think it's the consensus of the authors, believe that resisting fragmentation of the global financial system is in their collective interest, or building resiliency to the fragmentation is important. Could you talk about what you think one or two of the most important policy recommendations that stem from that?
Of course, I think, of course, the first best is still that we remain an integrated world, right? So I think this is something that we should never leave aside, and that we continue to cooperate at the global level. I think that's a very important measure. But there are, of course, we need to be realistic, right? And we see signs of fragmentation. So how can we address, the world in that kind of environment? And one way that we do also elaborate on the report is, for instance, establishing these coalitions of the willing, right? So finding at least groups of countries that still want to cooperate and find ways to cooperate would be an important way to overcome that. For countries, in particular in the emerging world, where Arnaud was just talking about as well, for instance, strengthening ties with regional financial arrangements and finding good ways for the IMF and regional financial arrangements to work together would be another important way, basically, as a policy recommendation. On the chapter on the payment system, we had, as you saw also in the presentation, a number of recommendations that we make there. But they're always linking up to the same thing, like, for instance, on when we think of risks to the crypto world, finding at least coalitions of the willing of countries, if not everybody wants to step in, and finding a common framework on the financial regulatory side, finding at least as many countries as possible that could do that. And then, of course, something that we also mentioned, we need to be careful, let's say, to kill the chicken with the golden egg, right? And this is on this sanctions measures, right, where there may be good reasons sometimes to put sanctions, but at the same time, we need to be careful to do that because, of course, those who can be subject to sanctions, or when there's unclarity on the reasons why we impose those sanctions, or it is perceived as not clear where we draw the line anymore for those, then, of course, countries may start moving to a fragmented system to protect them from potential sanctions in the future. So these are just a few of these recommendations that we make. There's also on specific areas where we make some recommendations, for instance, on sovereign debt restrictions. I think Maury was partly referring to that as well, and how we can move forward in that, like greater transparency. But we have actually a chapter in the report just on the policy recommendations, so I can also tell people to delve deeper in that. But I gave you already like a high-level view of
Yes,
what's the
thank you.
tricky.
Of course, the bottom line here is everybody should read the report. Gian Maria, I wonder, you spent a lot of time working on this report, and I wonder if you could, you sort of referred to this a little bit at the beginning of your presentation. When we get through the whole process, a year's worth of work, what were the things that, if there were any, that surprised you or you thought were particularly counter to conventional wisdom, if anything comes to mind?
I learned a lot from my co-authors. I think the understanding the centrality of payment systems is absolutely crucial. It's something that when I started thinking about the structure of the report, I thought should be there. And I think Isabel and Arnaud did a fantastic job on that. I think it is an area where international macroeconomists like me do not know enough. And it is really crucial to understand the plumbing. I'm working on the plumbing on the data front, but the plumbing in the on how transactions actually take place is unbelievably important. Reading books that talk about how sanctions work is absolutely illuminating. So that is one aspect that I think we ought to take into account when we think about the challenges that come from fragmentation. I focus portfolio diversification, but there are really big issues underneath in how the system works. I would say a second thing that I knew, but I hadn't really internalized the consequences, is the strength of financial links across advanced economies. A year ago, we thought, well, this is part of the same geopolitical bloc. Things now look more complicated, and hence highlighting that disruptions within advanced economies, if countries move further away from each other, could have really big consequences on how financial systems work, on the stability of the systems, on the financing of public debts. And these would be widespread, considering the centrality of the US for the workings of the global financial system.
Thank you. So Nathan, you talked in your report about how, despite all the headlines, the dollar remains a dominant currency. Even if it's lost some market share and reserves, it's still very important in the payment system. Maury made the interesting observation that we're running some pretty big shocks through the system now, whether it's sanctions or the technology changes. And I wondered if you feel comfortable thinking about what are the factors that will determine whether, if we sat here a decade or 2 decades from now, will have influenced the dollar's role in the international financial system?
That's a big question, maybe bigger and more forward-looking than I had tended to think as I was putting through the chapter together. It's hard, when you think about the international role of the dollar, it's hard to get, you can't get very far without coming across the phrase deep and open financial markets. If you look at the share of U.S. Treasuries, the volume of U.S. Treasuries outstanding, that's a safe asset that people want to hold, and there's enough of it that everyone can hold it, more or less, that wants to.
Well, we're taking care of that problem.
There's just really no other game in town in that space. There's ECB Chair Lagarde has written op-eds about hoping that the euro can kind of make some progress on that front. There's a lot there to do, but I think that sort of thinking about a change in that configuration Are there other currencies that might build their financial markets to such an extent that it could be an alternative? If you're thinking about where things might go or how things could change, you really have to think about that issue.
Right. So it seems to me the euro is a potential contender, although it's been a potential contender for some time. And that's about it. The Chinese, whatever they would like to think about the international of the RMB, it's going to be difficult for them without a different legal system and different kind of capital controls. So for now, it's not that the dollar is virtuous, it's that it's basically the only practical alternative. And the question is whether that will persist.
I'll leave aside the first part of that and just focus on the second. That yes, I think that that it is true that for the reasons I talked about, it kind of is the only game in town.
Anusha, one consequence of the dollar being such an important currency is that over the last couple of decades, I mean, I remember this very clearly from the global financial crisis, swap lines between the U.S., the Fed, and its counterparts in other countries have become very important. If there are banks in Europe that need dollars at a time of a crisis, the ECB can do a lot of things, but printing dollars isn't one of them. So we've worked out these arrangements where the central banks will swap currencies. And there was always a little bit of politics in this. I recall there were some countries that wanted to be eligible for Fed swaps that the Fed didn't really feel comfortable with at the time. But we're now at a point where geopolitics seem to have become increasingly important. And just to be blunt, it's not clear to me that if the Trump administration dominated the Federal Reserve, that other central banks could count on quite as much of a global view as we've seen so far. So I understand that's a leading question. So comment?
Yeah, absolutely. I think that, the in terms of the Fed or the ECB providing those swap lines, it's been done primarily on the basis of economic and financial ties, right? So there's been an economic rationale for providing those swap lines to, as I said earlier, systemically important partners in both trade and finance. But there is scope, and I think, the network of Chinese swap lines, for example, really raises the specter of geopolitics being involved in terms of a country trying to increase its sphere of influence by providing this liquidity, but also, it could come with, as it tries to expand its sphere of influence, it also could come with geopolitical leverage, a way to advance foreign policy objectives, and other objectives in order to increase its importance in the world financial system. And we are starting, there has been, as you mentioned, geopolitics involved during the global financial crisis. A number of emerging and developing countries, emerging markets in particular, wanted to be considered for swap lines. India was notably not extended a swap line. And that was on the basis of economics, but there was also some geopolitics involved in the granting of those swap lines. So it really is one of those territories which is uncharted in the world of the Fed and the ECB to a large extent, but especially in the US, if we start seeing more, politics, as we saw in the case of Argentina, it will be interesting to see how that provision of emergency liquidity gets provided. I think it's really sort of important to consider the bigger picture, right? Like, why is it that countries tap into those swap lines? It's because funding markets are under stress. This is a crisis response mechanism. And it's really it's concerning to think about what sort of disruptions that could cause in the international financial system if this type of emergency liquidity becomes subject to, statecraft, as I mentioned earlier.
Right. I mean, just as a point of fact, it's my understanding that the Federal Reserve has not entered into a swap line with the Argentine Central Bank, that so far this has been the province of the Treasury. Where they got the money is not entirely clear. But So I want to take a few questions. We don't have very much time for questions. I'm going to take 3 questions, and then we're not going to have every author answer every question. So we can start here, the woman here, and then in front, Anton. Please tell us who you are, and remember that we're short of time.
My name is Megan. I'm a student, so a lot of this is new to me. But I was wondering, for someone who wants to be a future legislator, how should we respond to this when it's our turn to take over?
Okay. Anton?
Quick question on the
Anton van Akmel.
Chinese swap lines. Very interesting. And of course, they fill the logical gap in the market. But what I couldn't hear in the presentations was how large are they and what are they as a percentage or in terms of numbers? And also one other question on the, you said there's a risk, logical, to foreign direct investment as fragmentation increases. To what extent is that counterbalanced by Trump's efforts to have all these big investments here, which is foreign direct investment?
Thank you. There's one in the very back, Chase.
Yeah, thank you. My name is Mehdi and I'm a student. So regarding this China's holding of US Treasury, which is close to around 750 billion. My question is that can that be leveraged in terms of geopolitics, somehow eventually, which can cause some sort of a shock for the US economy in general?
Thank you. So Anusha, do you want to take the question about the Chinese swap lines? How big are they? And I assume they're offering RMB, right? The Chinese?
Yeah, they're mostly renminbi liquidity, and it's to their trading partners. So one issue with China's global reach is opacity, right? So, but we do know, for example, the Chinese swap line with Argentina is $18 billion. And the US has offered 20.
Gian Maria, do you want to talk a little bit about FDI, the tension that Anton mentioned between, on one hand, we have fragmentation, on the other hand, Trump seems to be courting foreign investors?
We have issue is how we allocate production internationally. That is clearly being affected. We can discuss the extent to which you have, if you want, increased resilience of supply chains by having production structures located in countries with which you're having potentially fewer elements of tension. But in terms of global allocation of production, it is inconceivable to think that you're going to repatriate industries or that are clearly not viable in the United States. Furthermore, you have a component of foreign direct investment that has to do with the provision of services in other countries. And again, it serves an objective of certainly furthering the scope of domestic firms, but also increasing productivity and taking advantage of scale economies. And you curtail this on a systematic basis on the basis of political alliances. That certainly makes the global economy less efficient. So again, we can discuss the specifics of industries that are at the center of very delicate production structures, but I think in terms of general principles of where global production takes place, we are likely to witness a fall in productivity.
Does anybody want to take the very good question from the young woman about how should a future legislator take your insights and offer advice? You want to try that, Isabel? You don't have to.
It's a difficult question, but I think as we were talking about cross-border dimensions, it's always about coordination and cooperation. And for instance, when we take in the area of financial sector regulation, we had the FSB that does this kind of efforts, right? So at the BIS, there's been a lot of work on that, and I think it's in particular, having these fora continuing to discuss and find ways to cooperate, and making sure that at the global level there is consistency of what we do, I think, is an important factor there. And in particular, when we think about financial stability risk, that's really key.
Right. I think that Maury made this good point about it's so easy to overlook the importance of this regulatory coordination. And Gian Maria made the good point that payment systems are something you kind of treat it like your ATM. It's always going to be there, and I don't need to worry about it. And I think what we've learned, some during the global financial crisis, but with this report points out, is we can't take these things for granted, that they need to be nourished. And I would say they're too important to be left only to the insiders who can tell you what every acronym means, that the implications are broader than we often remember. Does anybody want to take the question about whether the Chinese holdings of U.S. Treasuries give them leverage?
I'll say that the reason that China and any other country holds U.S. Treasuries as reserves is because those are safe assets that they can rely on if things get difficult in times of financial stress. And trying to use those as leverage would, in many ways, negate the safety of the asset. And so I think that makes it difficult to think about that kind of eventuality, because what we're ultimately talking about is safe assets, and for many structural reasons, some of which you could see from Gian Maria's presentation, it's in countries' interest to hold a large stockpile of safe assets, in particular emerging markets, and the incentives to continue to hold those and to keep them safe are very large and very strong.
Right, and I think this points out an important issue that my colleague Nellie Lang has raised, that it would be a good idea if we had well-functioning treasury markets, because they're essential to not only the U.S. interests, but to the stability of the global regime. I can take another question or two if we have. There's one over here, or two questions over there. And Chase, can you walk down the aisle as a man in 3 rows up? Go ahead, ma'am.
Hi. I was listening and I kind of recognized that a lot of these were an accumulations of pressures, based on developing countries needed a more integrational financial systems. So what do you think this fragmentations means for them? Is this a good thing or a bad thing?
Thank you.
Hello. Oh, there we go. Hi, my name is Kwesi, and I'm a student. And my question is, with the rise of AI and the popularization of it, how do you think that will affect global markets on an international level?
So I think we've pretty much answered the first question on the vulnerability of emerging and developing economies. Arnaud answered that. It's basically not good for them. They're going to be more vulnerable. I think we talked not so much about AI, but about digital currencies. But AI is going to change the world enormously, or it won't. Come back in 10 years and I'll tell you which one it was. But does anybody want to take a stab at that, or to talk more about the digital currency issue?
I would mention maybe just one issue. I am clearly not the expert here on stable coins, but I would note that technology, the DLT, is not confined, is not the same thing as stablecoins. It's not confined to stablecoins. That digital ledgers can be used much more broadly, and hence it's just, I think, not right to say that stablecoins are basically summarized technological progress, because there is there are benefits from the underlying technologies that can be reaped in a much broader
I think it's
set
that as you look over the horizon, stablecoins are in the foreground, and you're saying there are other things in the background. And I think that goes for AI as well. It's a tool, and it will be used, and we'll have to see what impact it has and how much for good or ill. With that, please join me in thanking all the panelists. Wait a minute. Oh, wait, stop. I didn't mean to cut off Isabel. Please.
I will also make 2 points. One is on the AI specifically, because we actually have also reference to that in the report as a benefit. And particularly if you think about cross-border payments, a lot of things that slow down the payments and make it more complicated is this AML checks. And actually AI can be a great tool to be better at detecting anti-money laundering. And so that it can massively speed up, and hopefully it keeps countries integrated because we can reintegrate them into these corridors that have been cut off. So that's one thing I want to say. Another thing, if you allow me 1 minute on this, because
Please.
I'm a central banker and we're talking about swap lines, and there's 3 central bankers in the panel, and we kind of know what our institutions are doing in that regard. And I really ask you to look on the websites of the Fed and the ECB, and swap lines are really done for financial stability, domestic financial stability reasons, and that's on the grounds that we motivate them. And so geopolitics does not play a role in the thinking of an independent central bank in that regard. I just wanted to have that clarified.
Okay, thank you. Nathan seconds that, and David says so far. Please now help me join in thanking the panel. And please pick up your postcard outside so you can read the full report. And thank you to everybody for the questions and the presentations. Bye.